Hello there and welcome to the November Investor Update. I'm Brad Holland, Director of Investment Strategy, and this is the first in this series of updates under our new brand, JP Morgan Personal Investing. We remain as committed as ever to delivering clear, insightful updates for our clients, and in this video series we will continue to set out what is going on in financial markets and how we as an investment team are managing portfolios. With that, let's unpack the events of October, a busy month for investors. It was another positive month for many stock market indices, with tech-related companies being a key driver of performance around the globe. Specifically, it is the theme of investment in artificial intelligence, or AI, that continues unabated, pushing many indices higher. The US's tech-heavy NASDAQ index rose almost 5%. The AI theme isn't limited though to the US, and it was returns in some emerging markets that really caught the eye. There are companies based in both South Korea and Taiwan that are global leaders in the manufacturing of semiconductor chips. Now, this type of company may not grab the headlines as much as the AI models themselves, which are quickly becoming part of our day-to-day lives. However, semiconductors are essential hardware for AI models to operate. Taiwanese stocks were up almost 11% over the month, while South Korean stocks were the global leader, up more than 24%. Although these indices can be highly concentrated and volatile. For example, the South Korean index has two stocks that represent more than 40% of the index's market capitalization. Elsewhere, we saw Japanese equities posting significant returns, up over 7%, with a sense of optimism seemingly accompanying political developments there. In the UK, the FTSE 100, which reflects the performance of the 100 largest companies listed on the London Stock Exchange, that was up more than 4%. So with 10 months of the year now wrapped up, year-to-date returns across many equity markets are well into positive double digits. Looking at where returns are greater than 20%, we see the FTSE 100, the NASDAQ, Japan, Europe, emerging markets, and Canada, amongst others. Some markets are beginning to look a little expensive, which is something we are monitoring closely. However, our allocation to equities is still slightly higher than our long-term benchmark. We believe that equities continue to be well supported by the macro environment, which we'll take a closer look at shortly. In the UK, government bond yields, which reflect the level of interest payable to the investors in government debt, well, that fell in October. The 10-year yield, a key indicator of long-term borrowing costs, that fell to 4.4%, down almost 0.3% over the month. And this is the lowest level since December 2024, and this drop in yields has come with an increase in prices as they are inversely related. This change in yields was in part influenced by the possibility for fiscal tightening via tax increases. The UK Chancellor of the Exchequer, Rachel Reeves, has been preparing the public for possible tax increases ahead of the November budget. The budget will be watched closely by market participants for the level of commitment to fiscal prudence that it displays. Elsewhere, global inflation has continued to ease, and that has provided scope for further official rate cuts, which we saw in the US in October. And this has helped bond markets provide positive returns as bond yields fall. In terms of our fixed income positioning, our government bond exposure is roughly in line with our long-term benchmark. And this means we are not taking a strongly positive or negative view on the asset class either way. The UK inflation rate remains above the Bank of England's 2% target, but we think wages growth will moderate and lead services inflation and overall consumer price inflation down towards that 2% target in coming years. But the scope for rate cuts is limited if we don't see inflation continue to moderate as it did in the last month's reading. There is a lot going on in the US. The government shutdown that started on the 1st of October ran through the end of the month and into November. At the time of filming, it was into its 37th day, a new record. This has widespread consequences. From an investment perspective, something this is impacting is the availability of fresh economic data. Departments usually tasked with monitoring and producing statistics on the economy But they have been impacted too, and so there are fewer new statistics available. However, there are still other sources with qualitative surveys that assess the confidence in the economy, and they're pointing towards continued moderate growth in activity and employment. In the UK, there has been some positive news for the Chancellor. The International Monetary Fund, or the IMF, has upgraded its outlook for the UK economy. For 2025, the UK is now expected to be the second fastest growing of the world's most advanced economies, even though that growth is forecast at only 1.3%. On the 26th of November, Chancellor Rachel Reeves will present the budget, and we will be monitoring developments closely and will keep clients updated, so please do watch out for that. Well, thanks for watching. As always, if you have any questions or topics you'd like us to discuss in next month's Investor Update, you can contact us via social media, email, or in the comments below this video. See you again next time.